much, Professor Sohn, for this introductory remarks, and welcome to everybody who joins us either on this Zoom call or on the on YouTube. We cannot, of course, see the audience that is on YouTube. So this conference is spread out over 2 days, given the virtual nature of the conference, and I'm as much as anybody else, I'm really sorry to not be able to be in Seoul, which I've been several times before, and which I enjoy very much. And I hope there will be other occasions when we finally can reconvene in Seoul. So we have 2 days. First today for 2.5 hours, and then tomorrow for 2.5 hours. We have today 3 papers. And then tomorrow, 3 papers on international experience. Tomorrow, another paper on international experience, which will actually be presented by myself, and then a paper on Korea, so kind of applying what we learned from international experience to the Korean context. For each of the papers, we will have a short discussion, and then hopefully some questions from the floor. So without further ado, let me turn over to Steve Cicchetti, the former chief economist of the BIS and now professor at Brandeis University, who will talk to us about finance and technology, what is changing and what is not, which is joint work with, sorry, I forgot the name. He will tell us in a moment, and then afterwards we will have the discussant Xavier Vives. Steve, over to you.
Thank you very much. I'm attempting to share my screen.
Yes, that works.
Okay, very good. Oops. So first of all, let me join Torsten in thanking the Korea Institute of Finance, President Sohn, and Professor Park as well. And I too regret that we are forced to do this online, and that we're not able to be in Seoul this year. Hopefully next year that will change, and we can all see each other in person. This is a paper that Kim Schoenholz of NYU Stern and I prepared for this project, and our objective really was to ask some general questions and to try to provide a framework for thinking about how it is that technology influences finance, and how it is that traditional intermediaries are evolving. I think as you consider these questions, one of the most important things, at least for me, is to keep in mind that current structures evolved over hundreds of years, and they exist for a reason. There's a reason that we have banking and finance more generally in the forms that we do. They haven't changed hugely. A lot of things have changed, but the overall, the rough structure, I think, dates really to the Medicis in the Renaissance of Italy in the 13th century. So that's a long time. And in the meantime, there have been an enormous number of technological changes, and those changes have affected the types of products that we use, how we use them. But in a lot of ways, the general form is not changed that much. That may be changing now, but I think we have to think about it in this context. So. With that, as a very brief introduction, I want to talk, I'll cover the following 6 items again very quickly. First, I'll talk briefly about the costs of intermediation, then the role of finance, the impact of technology, the role of regulators. I'll make a few comments about digital currencies. I know that Andre's going to talk about that much more in far more detail later in the conference, and then I'll make a few speculative comments about where we're heading. And I'll just say right now that I'm very pleased that Xavier Vives has agreed to offer his comments, because he has spent a lot of time thinking about this last issue especially, and is much better informed than I am. So on the question of costs, this is Thomas Philippon's graph. Unfortunately, I lost the source at the bottom of the slide. I apologize. This is an amazing graph that is the unit cost of intermediation. And the amazing thing that I find about this graph is that it hasn't changed materially. This is for the United States in about 130 years. It still runs about 1.5% to 2% of assets per year. So that's enormous. This is also another reason, of course, that there's so much money in financial services is because of this. So the question, really the big question, is whether or not we're finally going to start seeing some material declines in this. It's declined before, but then gone back up again. You can see that in the middle of the graph as there sort of declines and then rises and then declines again. Philippon himself thinks that maybe it may be going down. I guess my own view is that the jury's still out. We'll have to see. Now, there are a couple of things, though, that you want to think about. So the fact is that costs remain high. There are a couple of reasons for this in general. In the paper, we have a few examples of this. One of them is in remittances, cross-border transfers, relatively small denomination cross-border transfers, things that are the equivalent of something like $200 to $500 or euros or something like that. And so these are transfers by migrant workers usually, or something like that, and they remain very high. The goal is to get them down to 5%. This is, of course, these are poor people to begin with, so this is quite a lot of money from their perspective. And the question is why we can't get it down. There are cheaper ways to transfer money across borders, but usually they end up with having banks at either end. I can transfer money relatively cheaply, as I'm sure almost everyone who's watching here can. But the trick of the providers of those transfer services is that they are taking money from one bank essentially and putting it into another bank. So what that means is that they don't have to worry about compliance. Compliance, especially associated with things like know your customer rules, something I'll come back to again in a few minutes, is quite high. And so if you go, for instance, to something like Western Union, one of the biggest global providers of remittance services, the amount of information that they have to collect and process for a transfer is quite large, and that's where the expense comes. A second problem that we face is that screening and monitoring for lenders and for borrowers remains important, and for insurance and the like. And it's also difficult, and it remains costly too. So when you try and reduce those costs, you discover that sometimes disaster strikes. Peer-to-peer lending is a fascinating example of this, because peer-to-peer lending, aside from having created problems in some jurisdictions, has not grown very rapidly. And part of the reason that it hasn't grown very rapidly is that in my view anyway, is that anyone who can get financing somewhere else, like a traditional financing source, will get it. And so peer-to-peer lending is really an exercise in adverse selection at some level. And you can see this in the data that comes from out of US peer-to-peer lenders, which they actually publish. You can see that there are clear adverse selection problems, and we also are going to see what happens to this, because we're having a recession now, which is the first recession since peer-to-peer lending really took off, and we'll see how long these things stick around. But the point is that you have to do the screening and the monitoring. So the question that we face is whether or not technology is going to reduce the cost of compliance and reduce the costs of screening and monitoring. If they do, which we can hope they will, then risk premia are going to fall, and access to credit is going to increase. And that seems like it could be a pretty good thing. Now, just to remind everybody what it is that finance is doing, finance is solving a whole set of problems and in the process channeling resources from savers to investors. And it solves these information problems associated with screening and monitoring. And it also then provides a very broad set a very broad set of services. And those services I've sort of listed here. We have there's a long discussion in a sort of big table. I'll talk about that in a second. But we all use a lot of these services. Here are what I would list as sort of 10 services that we can think of, categories of what it is that that financial intermediaries are providing for us. And there are a large number of different kinds of financial intermediaries, and they provide these in various configurations. Almost no one provides all of these. In fact, none of the examples that we have that I can think of provide all of them. Some of the reason for that in some cases is because of legal restrictions, regulatory limits on the scope of the services that they can provide. But otherwise, no one is doing all of it. So here are the services, and the question is then, how are these things going to be provided, and who's going to provide them? Right now, here are the categories. Again, a long list. This happens to be 11 categories of institutions that are providing those services. We all have depository banks. Most of us have brokers and underwriters. We may use asset managers. We probably have some insurance companies. Virtually all of us have property and casualty insurers. Some of us have life insurers. All of these have balance sheets, except for the credit rating and scoring agencies that just provide information. All of them have balance sheets, and all of them, and all of their balance sheets have sort of different. They come in different flavors and different forms. So we can go through all of these if we want, and we do it again. I can say we can do it. You can think of what is it that these people are actually doing. So if I look at a depository bank and ask what is it that a traditional commercial bank does for us, a traditional commercial bank is engaged in a whole set of these. This is 8 of the 10 functions or activities or services that I listed. A normal bank will engage in, and of course a universal bank will do all of them, because a universal bank is also an investment bank as well. But many of the question that we have to ask then is why is it that these things are configured this way? I can keep going. Here's what the brokers and the underwriters are doing. The only thing that they don't take deposits in most cases, although some of them might. I can also look at life insurers or private equity and venture capital firms. And remember, all these things exist for a reason. I mean, just to focus on the private equity and venture capital guys, these people provide early stage finance and later stage finance for companies, the venture capitalists especially, and people are trying to create crowdfunding platforms to provide early stage finance for startups. The question is whether that makes any sense, or whether or not these venture capital firms are adding value by doing the kind of specialized investigations, their screening, and then also their collaboration by providing certain kinds of skills to the people that they finance. And so those sorts of things, if you have crowdfunding platforms, all you get is some funding, but it's not clear that it makes how much sense it makes, and it certainly isn't very large, at least not yet. Now we can go through the rest of these if we wanted, and they just a few of them. There are also central clearing parties and exchanges. There are custodians. These people all provide some form of this, and then there are credit rating agencies that are quite specialized. So the issue is what the impact of technology is going to be on the delivery of these services, who delivers them, how they deliver them, and what the access is going to be. Now, I should say that there's always a danger in all of this. we have examples clearly of where technology has created wasteful arms races. My favorite example is high frequency or high speed equity trading, where people use technology expending massive amounts of resources in order to get milliseconds or even less increases in their speed. But there are also scale economies. Torsten, how much time do I have left?
5 minutes, actually. If that's
Thank
possible.
you. Thank you. Yes, absolutely. They have their scale economies, network benefits that are important, but these can create competition and stability issues. There also are issues of scope economies if they exist. FinTechs so far tend to focus on a few narrow functions. The one that is the most popular or the most crowded now among that has had the most entry is payments. And of course, one of the reasons for this is that payments is a case where there was a fair amount of concentration, very few providers, and as a consequence, there had not been much innovation for a long time, or the innovation came in fits and starts, and so it was sort of primed for entry by somebody with new technologies. But the fundamental question in thinking about whether you can break these things up is whether or not there are complementarities that will limit the benefits of unbundling. So, for instance, deposit taking and liquidity provision are the classic example of things that are really sort of seem to go together. Having liquid assets and having liquid liabilities. Somebody who's good at that can also offer lines of credit, and that seems like a important thing. And they also then end up collecting lots of information. But then you have this question about who gets access and who owns the information and the like. Those are important things. We'll come to those over the course of the conference. Turning to the regulators very briefly. The regulators, I think, need to follow a set of principles. They need to encourage entry. Very importantly, they need to ensure compliance, and they need to safeguard resilience. I think that as you think about attempts at regulatory, that you want to be careful not to engage in certain kinds of regulatory forbearance. If somebody can figure out a cheaper way to meet compliance requirements, money laundering, anti-money laundering, countering terrorist finance, and the like, that's fine, but they have to meet the requirements. The ultimate objective can't change. The other thing is that regulators can actually aid all of this by providing a support in certain directions. So, okay, there, can you hear me? Okay, I was muted by the host for a moment. Okay, so to continue, the official sector, the authorities can actually aid all of this process by working on digital identity systems. Digital identity systems have to be, for three classes of things. The first thing is for individuals, that's households. The second for institutions, firms, and the third is for instruments, that's the securities. Then we also need data sharing and protection regimes and protocols. And finally, we need to provide clear information on regulatory practice. I don't have time to talk about the digital currencies, except to say that there are some, on the private side, I think that there are issues of whether these are really faster, cheaper, and safer than official sector government supplied currencies. And on central bank digital currencies, I think there are three important challenges that have to be met. One of them is knowing your customer. They're going to have to know your customer. Otherwise, the central bank cannot be a facilitator of criminal activity. They're going to have to avoid disintermediating the banking system, which is going to happen if there's stress in banks and people rush into central bank digital currency, and they'll have to guard against currency substitution where a jurisdiction that is perceived to be risky loses cross-border, loses capital and intermediated assets to safe ones. So where are we going? And this is the final slide. I think there are two possibilities. One of them is that that because of the existence of network externalities and these sorts of certain complementarities of data and the provision of financial services, that big tech companies might take over finance. We haven't seen any of this yet. They've partnered with, at least not that I know of, they've partnered with financial intermediaries. You know, Amazon's in a partnership with JP Morgan Chase, Apple with Goldman Sachs. They look like airline alliances, not like financial intermediation itself. And then alternatively, banks could dominate. Banks, of course, are technology companies. 10%, up to 10% of their budgets are spent on technology. So finally, the considerations on this is going to be, what is it that banks do, and also what is it that central banks do? Central banks are going to play a critical role, as will regulators. I've probably gone over my time, so I will stop there, and I will stop sharing my screen. Thank you very much.
Well, thank you very much, Steve. Also thanking for mentioning at least once the word airline to remind us what we're missing currently out on. Over to our discussant, Xavier, professor at IESE in IESE Business School in Spain, who has also worked, as Steve already pointed out, quite a lot on this topic. Please, Xavier, go ahead.
Thank you. You see my screen well, and you hear me well? Yes. Okay, thank you. So let me start by thanking the Korea Institute of Finance and the organizers this meeting to allow me to be here, although only virtually given the circumstances. So I'm going to take basically over from where Steve left. So that's where is the banking system heading, basically. And mostly I will draw from my article at the end of last year on the annual review of financial economics on digital disruption in banking, for those of you that want to go a little bit deeper on what I'm going to say today. So as Steve has pointed out, the core functions of financial intermediation are clear, but here in this slide, mostly what I want to emphasize is that financial intermediation has a lot to do with information processing, and the big change that we have today is that we are transforming masses of soft information into hard information because of the use of artificial intelligence and machine learning using big data. So this is a huge change, in fact, that even allows the substitution of collateral for information. This means that many dollars, if you want banking, incumbent banking dollars are at risk by the digitalization in different financial services. And as this table shows, mostly in payments, that's as Steve has mentioned, but also in retail banking, in particular in credit. The impact is important because it's transformational. There is leapfrogging, so people that have never banked in a regular bank, now they bank with the mobile phone. It moves the sector to be customer-centered and platform-based, and I will come back to that. And on the other side, leaves incumbents with obsolete technologies, typically over standard branch networks, and with mainframes instead of cloud computing, so not very flexible. And so the industry is facing a very deep restructure. The advantages of FinTech technology are several: superior technology, free of legacy systems, linear operation, friendly consumer interface, a new standard of consumer experience, focus on activities and business segments with higher returns on equity, like, for example, payments or transfers. And in fact, on remittances, I think I'm going to be a little bit more optimistic than Steve. I think they will go down, and they are going down. Also, they tend to the fintech outlets tend to have more equity funding and are able to attract the best talent. However, they don't have an installed base of loyal customers, particularly the small fintechs, that they have limited access to some information, they lack reputation and brand recognition, have a higher cost of capital, and a small balance sheet. Although some of the fintechs in the US, thanks to the government sponsored enterprises, can operate with a small balance sheet. They also lack regulatory and risk management experience and expertise, and in principle have no access to a central bank backstop, okay, without a banking license, although here with digital currencies we'll see where to go. The point is that big tech platforms have basically all the advantages of fintechs with no drawbacks, well, except this last box where the access to the central bank and regulatory expertise. But they have superior data, network economies, technology, big pocket. They also have a lobbying power. So this means that potentially they have a much more severe disruption of the traditional banking business than the small fintechs. As it is well known, big techs manage to have a lot of activity. With this activity, they generate a lot of data. With this data, they generate more activity, and this feedbacks into activity. It is a dynamic economy of scale, very similar to the learning curve, which has been very well studied. What about the strategies that the fintechs and the incumbents, and here I'm referring more to the small fintechs, can use? Well, as typically is the case, the incumbents can either accommodate the new entrants or fight them. Accommodate like a fat cat, a peaceful fat cat, which tries to gain from the, in fact, from the, by discriminating by segment, basically, from the entrants, for example, to gain interchange fees paid to them by the new service operators, or otherwise can confront them directly, try to shut down them, degrade access so that they cannot enter or have a very difficult life. And there are examples of both. Fintech strategies, in essence, can do the same, but it's kind of symmetrical. They can be like a nice dog, puppy dog ploys, you know, a very nice and not aggressive dog. They commit to remain small. Maybe they don't even ask for a banking license. They cater to on-bank segments of the population. They may form partnerships with incumbents when they want to accommodate. Or they may try to enter, even as a fully licensed digital bank. We have some examples in Europe now, for example, and in other places. This is less likely in some jurisdictions also because of the high compliance cost. And then at the end, they may consolidate or sell to incumbents, or if they manage to grow and get economies of scale to enough economies of scale to operate. What about the incumbents vis-a-vis the big techs? Well, the big tech, when deciding to enter financial services, and they are entering financial services in different forms, payments and credits, for example, they either can accommodate, again, have an accommodation strategy, forming partnerships, as Steve has mentioned, with established banks, or they can try to compete head-to-head. And they can try to compete head-to-head in two ways. Either they set a bank or an intermediary subsidiary, bundling their offerings and exploiting the economies of scope with a wide range of products and services that the big techs offer. Maybe opting not to accept deposits to avoid more heavier regulation, and this could be a type of a model. Or they can just stay as a multi-sided platform, as a marketplace, and trying to use the typical big tech strategy of platform development, which is basically do everything that the rivals do and more. Okay, and then cater to the ecosystem that has been created by the big tech, being a gatekeeper for the customers and monopolizing the interface with customers. The incumbents, again, may decide to accommodate, cooperate with partnerships, maybe provide some specialized services, or compete head-to-head. Competing head-to-head means basically becoming also a platform and a marketplace. Maybe they can profit from superior trust from customers and data security. Probably many people would trust rather their data to the bank than to Facebook, say. They may have better regulatory navigation skills. They have, in fact, similar lobbying power than big tech.
Javier,
but definitely what they cannot do is match the big tech bundling or cross-subsidization strategy with complementary financial and non-financial products. Where does this send us? So let me just skip. This is just an example of the ecosystem of the financial system. Well, big techs they have very deep pocket. The capitalization of the big techs is huge compared to the largest banks. And now we'll see Ant Financial, which is a platform, right, also, and, which will grow, in fact, in value. And then maybe the future, so this was the question posed at the end by Steve, will be something like this. In a sense, maybe kind of new platform-based oligopoly, where services will be delivered by platforms, and then the only question is who will be on those platforms, whether some big techs or whether some transform incumbents, okay, or both, okay. And then financial service providers will provide the services through the platform to customers, which will be the gatekeepers of the ecosystem. And then basically the degree of competition between those platforms will depend very much on the switching costs of going from one ecosystem to another and the interoperability of those ecosystems. So this will be the key thing. And how this will work out? Well, this will work out basically because of changes in regulation. Okay, so how regulation will deal with these different ecosystems and with the entrants and with the incumbents may determine very much what's the end result in terms of market structure and the degree of competition. That's to say, the competitiveness, the very competitiveness of the entrants, be it fintech or big tech, will depend on the extent of regulatory burden, guarantees, schemes, and stability concerns. Okay, so and then the question, which I think also was hinted by Steve, is whether regulation should aim at a level playing field or favor entrants in order to promote the competition, and the question has not been completely solved. Torsten, should I stop here, or I have some comments on regulation and stability I could make now or later? If
maybe let's first, thank you very much, Javier. Maybe let's stop here for the moment and see whether there are questions, and then maybe if there's something.
Okay.
Very good. So can I ask in Seoul, are there any specific questions, any comments? Maybe also from the audience outside? Okay, I cannot hear anything. Steve, do you want to respond to any of the comments that Javier?
No, I mean, I think that you know, I guess part of it is that my thinking, the structure that Xavier has set up has very much influenced the way that I think about it, and so I don't have much to disagree with at all. I think the issue, as he points out, is going to be how this the transition is going to be complicated, and the transition and the regulation will drive the transition and will drive how it is that the final the system looks at the end. I mean, as it stands right now, as I try to suggest, the banks are trying to create the platforms. Whether they're going to succeed or not is another issue, and they are trying to deal with they're trying to deal with the fintech entrants, either by buying them or by creating competing technologies inside of their own systems, something similar to what the big techs do, right? Which is to take the financing they have and just buy up stuff or start their own incubators inside of them to do that. So the question I think that Xavier left with is exactly the right one, which is, you know, it looks like we're headed, because of the nature of the technologies and the nature of the way that information systems work, we're headed towards an oligopolistic system. The question is, what's it going to look like? And then what's going to happen to the costs, and whether or not that oligopolistic system is, sort of how is that going to then go forward? So I'd be very interested to hear his comments on the regulatory side, because I think that's an essential part of this.
Let me maybe just also add to this. Actually, that was also my question I kind of scribbled down is, I mean, you mentioned the strategies by both big techs and by banks, but of course, both the reaction of these players and the success of these strategies will of course depend a lot on the regulatory response. So that was exactly also one of my questions. And of course, the other open question, and that's an easy question, of course, to ask is, do you see these trends being accelerated or orthogonal, for example, to the current pandemic, COVID-19?
May I say? Yeah. So definitely the trends are accelerating. So this is no doubt that more people use the digital banking services now than before. So probably it has accelerated a few years. So that's my view. Maybe 3, 4, 5 years. It has been accelerated, even for older people that really have not been able to go to the branch. So they have moved to the digital. No? So this is clear. And not only that, also on the side of banks. Banks have discovered that many people can work from home also, so can work at the digital operational distance. So I think all this is a huge acceleration in favor of digital technology, and that's why we see that big techs again dominate 20% of the S&P 500. Okay, so this one of those. Then, in terms of regulation, just two comments I would like to make. One is that consumer protection comes to the forefront with digital technology, because the capacity of digital technology to behaviorally discriminate among customers and issues of privacy are very, very important. And so, for example, who owns the data? Okay. So in my view, I think that what can approach an optimal solution is that customers own the data. Okay, so basically not big techs or institutions. This is not fully optimal, but it's closer to the optimal than the other side in a sense. So that's one thing. The other issue, which I think it's important to realize, is that apart from the strict regulation, whether in favor entrance or not, the sandboxes, how do you allow the entrance to train, etc., is the issue of financial stability, the implications for financial stability. And then here we have different implications, obviously, in the sense that, for example, cloud computing is relatively concentrated, and large, efficient digital services are quite concentrated. So this means that if one of these big services fails, in a sense, or has a problem, then many banks may be in trouble. Okay, so this is a new kind of systemic risk, which is on top of cyber risk. Okay, so that's one type of new issue, if you want, which I think regulators are well aware of that. And then another, which is I think is more subtle, is about guarantees. So the system, the banking system, I mean, has a safety net, has a lot of guarantees, etc. But what about the entrance? So, for example, in the US, we cannot explain the growth of in mortgages, in particular, of FinTech and shadow banking in mortgages, if the government-sponsored enterprises were not buying, offloading basically from the balance sheet of these institutions those loans. Okay, so this means that in this sense, so the story I think is simple. Regulatory pressure makes regular financial intermediaries, banks, kind of go backwards a little bit, so refrain from being aggressive in the mortgage market. And then all these new entrants enter with a small balance sheet. Why they can enter with a small balance sheet? Well, because they can unload the loans in the government-sponsored enterprise. And I think this, I don't know if it is this, I mean, what I fear is this is not by design, right? And so that we better, regulators better think together all the implications and of these implicit guarantees, because they have huge consequences, which may be good or may be bad, but at least I think they should be internalized by the regulator.
Thank you very much, Javier. Let me see, was there any other comments or questions from the audience?
I have a question.
Yes, please.
Would it be possible for bank holding companies to invest in all sorts of FinTech companies to convert themselves into huge financial platform companies? Is it feasible, or is it realistic? And if it's going to happen anyway, then what are the regulatory changes that are needed in this kind of situation?
Okay, Steve, maybe you want to?
Yeah, well, I'll give one answer, and Xavier can he can tell me I'm wrong. My answer is pretty simple, and that is that at least the banks in this country that I know of are doing one of two things. They are buying fintechs, or they have their own incubators inside where they develop their own technologies, or both. And some of these things that Xavier mentioned about information use and targeting of customers and the like, you see the banks doing it already. They're doing it in the same way that if you go on the Amazon website, I mean, I do all these things. If you go on the Amazon website and it's making suggestions, if I go on the Bank of America website, it's making suggestions, and those suggestions are tailored to me. It's very clear that they're tailored to me. They know a lot about me, and they're using that information to try to sell me products. Both of them are doing that. And of course, like anybody else, I'm susceptible to their marketing, and sometimes I give in. So I think that the answer is that in terms of some of the things that Xavier was mentioning, in terms of issues associated with customer protection, as well as the things that I was emphasizing associated with various other kinds of compliance problems, the extent to which this stuff gets sucked into banks, that reduces the regulatory problem. It also reduces the problem of things like access to central banks and the like. It doesn't change whether or not the guarantees are creating distortions. The last example that Xavier gave, I think, of mortgages is an extremely important one. But that's exactly what entrants do, is they find arbitrage opportunities. Rocket Mortgage, which I think is the biggest of the things in this country that meets your description, Xavier, is clearly, very clearly, an arbitrage opportunity. I mean, that sort of grew out of nothing, and now it's the biggest mortgage. It's the biggest mortgage originator in the country, but it doesn't have a balance sheet, really, because it just sells it all. It's an originator and a servicer of mortgages, and that's how so it's a fee-based company. It's not a company that makes funds off of maturity transformation or liquidity transformation. So I think the issue is more what Xavier pointed out, at least in my mind, and that is, if this stuff starts to exist in outside of the regulated banking system in any scale, then you have to figure out what you're going to do about it. But I'll let Xavier talk about that.
Yeah, no, just
jump in very quickly. Leonardo also.
Yeah, very quickly.
And I gave.
Very quickly. No, just I think the answer is that yes, banks want to become platforms, and the reason that they want to become platforms is that if they don't do that, they fear that the all the financial services will go through platforms and that they will not control the distribution of the financial products. And so that's why they are trying to do that. And the only question is whether how successful they will be. I think some they will be successful. Some of the more tech-savvy banks, they will be successful. Others not, and they will die. I think quite a few banks will be dead in 5-10 years, quite a few. The only question is whether they know it or not, or they will go out of business, basically. And then the question is, from the point of view of a platform, whether it's like Amazon. So whether Amazon will just sell books, started selling books of others, but then started selling its own products also. So in a sense,
oh, sorry. Lost you, Javier. Javier?
The subsidiary with their own financial products, right? And then this will be new issues, which in fact they are being discussed in the big tech competition policy regulation debate, which now we have in the US and in Europe. Okay, so I think it will be very, my sense is very transformational, and one issue obviously that will have to be regulators very careful. And in the US, for example, there is this issue of not mixing banking and commerce, so that most likely, as Walmart was not allowed to set up a bank, okay, so we'll see how the regulation evolves in the US, whether big techs are allowed to set a banking subsidiary in a sense or not, okay? Probably not, maybe now, but who knows, no? I mean, things are not this easy to foresee.
Thank you, Javier. Leonardo wanted to make a quick point.
Yes, Thorsten, thank you very much. I would just to contribute with one comment on another angle through which to analyze how the entry of big tech in finance could modify financial intermediation, and it's the angle of data that replace collateral. So we have performed an analysis with the BIS with the Ant Group using credit of firms in China that get credit from both Ant Group and banks, and we show that the massive amount of data collected by many sources by the big tech companies, payment, e-commerce platforms, social media, to assess the firm's credit worthiness, reduce the importance of collateral in solving an asymmetric information problem. So, of course, the replacing of collateral with data is particularly important for small and medium enterprise. And in many cases, they don't have financial statement and are therefore particularly opaque. But from a macroeconomic point of view, the fact that the data replace collateral simply means that the financial accelerator mechanism reduces effectiveness and importance. And this has also relevant effects for the monetary policy transmission mechanism, for example. So it's another angle through which we have to reconsider maybe some of our paradigms.
Thank you, Leonardo.
Thank you, Leonardo.
Are there any further comments and questions before we close this session? So I don't see so. Well, thank you very much, Steve, for the presentation, Javier, for the comments. We're going to skip the break, but I'm going to make sure we're going to have one after this session. So one of the topics that has been already kind of touched upon are cryptocurrencies. And of course, when we talk about the future of banking, when we talk about the future of monetary policy, as just alluded to by Leonardo, then we have to definitely talk about cryptocurrencies. And so this is the next presentation by Andrei Kirilenko, from University of Cambridge. And as I mentioned, no, I haven't mentioned yet, unfortunately, well, not unfortunately, fortunately, our discussant is not available because she gave birth 2 weeks early. So that's, of course, very good news. I have a few remarks afterwards, but the main part of the session will be Andrei's presentation. Andrei, all yours, please.
Thank you very much. Can you hear me okay? Great. So let me attempt to share my screen. and it's sharing something that's not that. How about this one?
Yes, we can see it. Thank you.
Yeah, can you see it all right?
Indeed.
Perfect. So again, I'd like to thank the organizers for having me here. It is indeed a pity that we cannot be together in the room in Seoul, but we'll do the best we can under the current environment and utilize the digital technologies that have changed the financial services industry so much. This is joint work with one of my PhD students, Binelza Hayes, who is at the University of Liechtenstein. So these are just some views that I've sort of developed over a period of time. And
Andre, can you do full screen? This gets cut off at the bottom from our view.
I can do, let me attempt to do full screen. Just give me a second.
Get on my screen, Steve. Not sure why.
How about this? Is this better?
I'll manage. Thanks.
Let me. Yeah, this is.
Just go ahead. Go ahead. I'm sorry.
Screen on my end. Yeah. Or is this better? Let me try to do this way.
I think just go ahead, please, Andre. I think it's fine.
All right. So Bitcoin was proposed in 2008 in the response to the global financial crisis, and it went live in 2009. It was very explicitly proposed in response to the global financial crisis that there was a perception that the financial services industry at the time was failing. The whole world was entering into a crisis, and this was proposed to the world. It was proposed, as you know, in a very specific, very technological way by someone who remains anonymous. And then over time, it just sort of went live and then became a household word in a few years. Now, I at the time was part of the regulatory community. I was part of the Commodity Futures Trading Commission, and working on the actual redesign of the financial system as part of a large team. So the regulators, and I could tell you now from my experience and experience of others, regulators around the world were busy with the global financial crisis and the European banking crisis that continued just sort of playing out of that. So like many other things related to technology, they sort of became overlooked. Ethereum was proposed in 2013 and went live in 2015. And as far as I could tell, since about 2015, everything else in crypto has in some way been stalled by regulators. There was, various attempts, but the regulators by about 2015 have caught up with the regulatory effort that they were going through and really started paying attention to crypto. Why? Why is that the case? Regulators in the US, in Europe, in my opinion, are actually quite proficient in regulating digital events recorded in computer databases. There are many things that are already digital, have become digital. Issuance of securities is digital. Initiation and completion of payments is all digital. Trading and settlement of assets is digital. Submission of reports to regulators is digital. So why is it regulators find it so challenging to regulate activities and entities involved with blockchain technology? It is one of the fundamental technologies that, in my opinion, powers the FinTech revolution. What is it about this particular technology? And I personally find two main challenges that I think make it difficult for the regulators in the US and Europe to deal with it. And both challenges are embedded in the blockchain technology itself, which I will not go through. Many of you are probably familiar with how blockchain technology works. It consists of various parts. The two most probably important parts of this technology are cryptographic primitives, what kind of cryptographic and encryption technology you use, and a consensus mechanism. How do you propose a new state and how do you adopt a new state? Now, challenge one in that I feel is a big challenge for regulators, but it's not insurmountable, is that cryptocurrencies are incorporeal rights to a digital object with no intrinsic value. So let me unpack it for you. So these are rights. So in this technology, so the events, if you will, and states have never had a physical equivalent. So many other aspects of the financial services industry had a physical equivalent. We're still sort of calling for fixed income instrument coupon a coupon. It was literally a coupon, physical coupon attached to a physical medium. Now they've become digital, but they had a physical equivalent, and with that physical equivalent, there was a body of law and property rights that developed that was then transferred into a digital domain. So there was a digital representation of a physical set of rights. In this particular case, these are incorporeal rights. They only exist in the digital domain. And so these are digital objects, and they, in principle, have no intrinsic value. Now, this is difficult, but it's not insurmountable. So, for example, a CDS swap is a stream of incorporeal rights to an occurrence with no intrinsic value. So, the regulators in the US and Europe sort of know how to deal with this. They've dealt with this in the past. Now, you can say that some of these innovations including CDS and other types of OTC derivatives were the underlying culprit for the global financial crisis. But again, regulators have become quite proficient with that. So that to me is an important aspect, but not insurmountable. What to me is sort of a big aspect of a blockchain technology that associated with cryptocurrencies specifically that really stalled the regulators and made them do what they do is that decentralized blockchain applications actually facilitate transactions outside national payment systems, because blockchain creates its own payment protocol. And that latter challenge makes it all but impossible, in my opinion, to bring cryptocurrencies in their pure form into national regulatory boundaries. Let me quote for you, we have a couple of people here from the Bank for International Settlements, associated in the past or associated now. And this is, which is doing a great job, and it's been on the forefront of a number of issues associated with the also global financial crisis. If you will, the global financial crisis really amplified the importance and the abilities of the Bank for International Settlements, the way I see it. So this is a speech of their current general manager, Agustin Carstens, entitled "Money and Payment Systems in the Digital Age." And one of the parts of that speech is that cryptocurrencies fake money. So let me read it to you. No discussion of money and payments in the digital age would be complete without addressing cryptocurrencies. But are cryptocurrencies money? No. The use of currencies is misleading. Cryptocurrencies such as Bitcoin, Ether, do not serve the core functions of money. No cryptocurrency is a true unit of account or a payment instrument, and we have seen this year that they are a poor store of value. This then raises the question, what are they? Let me expand. So Bitcoin could be called the original blockchain app. And this is It's a decentralized digital currency. This is from the Bitcoin wiki that enables instant payments to anyone, anywhere in the world. Uses peer-to-peer technology to operate with no central authority and carried out collectively by the network. So the white paper associated with Bitcoin was posted in November 2008. The first version of the open source software that enables transacting in Bitcoin, Bitcoin D 0.10, was released in January 2009, and we're now on the current 16th version, as far as I know. So Bitcoin blockchain is a state machine. It moves from one state, so a computer is a state machine. It has a state, and then there is a transition, and then another state. So you can think of, and that's the way to sort of think about Bitcoin, is a state transition system. It starts with a state, and the current state is a record of ownership status of all existing coins. It's transaction-based. It's a chain of digital signatures. And the next state is the amended record of ownership of all existing unspent coins. So the state transition is implemented via what's called proof of work consensus mechanism. So that is what Bitcoin blockchain is. This is the way to visualize it. Bitcoin blockchain, the way I think about it, is a global decentralized transaction-based payment system that exists outside of national boundaries. It exists outside of national payment system. It is designed for transaction processing, verification, validation, and storage. It's a robust state machine. So, I mean, it's still around. I mean, so there have been so many attempts to actually to attack it, but it's still around. But 2008 is a technology. It was before mobile phones and before before smartphones, to be specific, and before many other innovations in open source technology. So in 2013, you had Ethereum entering into the space, and Ethereum is a platform designed for building and executing decentralized apps. So you can do it on the Bitcoin blockchain, but it's a bit clunky. People have tried, but instead they decided to build a more sophisticated version of it. This one is account-based. It's not a transactions-based, but an account-based state machine. It moves from one state to another state, again, through a transaction, but there are accounts there as opposed to just digital signatures on which are pair type of instruments. Again, implemented through a proof of work consensus algorithm, which has its own sort of version of it. And it goes from a current state of all records of all accounts to the next state amended record of all accounts. So this one is sort of a more sophisticated, again, payment system. But it's not just a payment system, it's a payment system within which you can run actually quite a bit more. You can think of it as it's a payment system, it's a payment backbone, and the SWIFT technology on top of it, only much more sophisticated SWIFT. So here's what the founder of blockchain called Ethereum. He called it a magic computer which carries a very strong crypto-economically secured guarantee that programs running on the chain will continue to execute in exactly the same way the blockchain protocol specifies. So I actually met the founder of Ethereum shortly after he launched it. I met him in Boston, and in literally a basement of a building. And at that time, shortly after I left the regulatory space, and I was still very much influenced by the global financial crisis and how the regulatory redesign. And so here I meet this young man, and it had a feel of a religious sect. You know, there was a small group of people who were all had, you know, sort of their eyes, and they were sort of uniting around something that really had a feel of a new religion. And
Andre,
that,
5 more minutes.
you know, I'm sorry,
Andre,
what?
5 more minutes.
5 more minutes. So I thought, look, you know, these people are probably a little bit not understanding what they're doing. But I did subsequently look quite a bit into what the blockchain technology, and there is actually quite a bit with that we can learn from this religion to take it forward. And here is Agustin Carstens, who's saying that buyers of cryptocurrencies are buying into nothing more than a software algorithm. Cryptocurrencies are fake. Well, cryptocurrencies are fake to the extent that they're not economically guaranteed by a state. But as we know, a state guaranteed to honor its economic commitments in the future is also to some extent fake. You know, we have seen a number of states over time. Many states have failed to guarantee their economic commitments. So it's not like these commitments have never been sort of challenged. So one way in which, and which people alluded to, that the central banks have resolved that is bringing decentralized blockchain applications in the form of central bank digital currencies. In fact, again, quoting from the BIS report on central bank digital currencies, any CBDC will be first and foremost designed for domestic users and a domestic payment system. It's very, very clear. But is a domestic payment system not just a software algorithm? It is just a software algorithm, right? So what about crypto assets and market regulators? So a crypto asset is an intangible digital asset whose issue and sale or transfer is secured by cryptographic technology and shared electronically via a distributed ledger. It's intangible, it's digital, and it's held in expectation of future economic benefits. It's an asset. And assets are domain of market regulators. So here are the various US regulators that have been involved, that involved themselves with crypto assets. And so as you may know, there are multiple layers of regulators in the United States. There are federal criminal regulators such as FinTech, Department of Justice, Department of Homeland Security. So they've gotten involved in cryptocurrencies in particular. As I said, I alluded to 2015. So 2015 was the action against Ripple Labs initiated by FinTech for failure to register as a money service business. So they approach it from anti-money laundering sort of perspective. Department of Justice went after Silk Road for facilitating unlawful transactions, and it also involved with issues related to tax liabilities. Department of Homeland Security looks into terrorism financing investigations and cases. In addition, there are federal banking regulators. So Office of the Comptroller of the Currency has created a FinTech charter that potentially makes it possible. Again, it evolved to get involved with cryptocurrencies. One of the additional elements that's just sort of, it's sort of stalled on its own as well. It got challenged for a variety of reasons. FDIC started looking into cryptocurrencies because of bankruptcy resolution cases. They would go and they would shut down the bank, and then it turns out that there are some assets that are cryptocurrencies. So they had to quickly develop a mechanism through bankruptcy resolution, how to find those and how to bring them into the bankruptcy resolution issue. They also subsequently moved and created something, actually issued for the first one, the industrial loan company charter to Square. So that's a way to create sort of a bank while not being a bank. Federal markets regulators, CFTC, where I used to be, and the SEC, they have approached it very differently. They have very different philosophies in the way they regulate. So CFTC's is very comfortable with crypto derivatives. It approved exchanges and clearing houses. It has some enforcement activity primarily along the lines of fair and orderly markets. SEC, on the other hand, has been much stricter in terms of basically not allowing crypto ETFs and going with very stringent enforcement actions on the on crypto-related issues. There are also various state regulators that are looking into, it's quite a bit of an arms race actually on the state side in figuring out how to bring this, potentially bring this crypto business in California, in Florida, in Nevada, in New York, Washington State, and Wyoming. They're creating possibilities. Very interesting developments actually there. And the European market regulators have approached it differently. In Switzerland, they've issued digital securities offering guidelines. In the EU, there are some EU-wide related regulatory practices, GDPR, Know Your Customer, FATF. And then there have been developments in various countries. In Estonia, they started issuing crypto licenses in 2017, and then in 2020, they really tightened that. So they actually canceled quite a few of them. In France, there are some laws on digital custody. In Germany, recent law on the guidance of crypto assets and issuance of ICO. Gibraltar and Malta have created, these are traditional activities associated with online gaming as well. So they've created token regulations on virtual financial assets. In the UK, there's a crypto assets task force and the FCA sandbox on crypto. So there's sort of developments in this area, but from what I can see, it's mostly in the direction of how do you take this technology and mold it into the existing mandates. And regulators have their own mandates. They have a monetary policy mandate, financial stability mandate, payments mandate, fair and orderly market mandate, customer protection mandate. So these mandates and these technologies don't overlap very well. But as far as I can tell, the two ways in this diverged for central banks, they're really looking at blockchain as a possibility of transition into central banks that are retail payment or wholesale payment type of environment. And for the markets regulators, the way where the majority of just sort of things that are happening is probably on the custody and making it institutionally viable for institutional investors to actually participate in this. I will end here. Thank you very much.
Thank you very much, Andrei. So if you maybe can stop sharing so I can share myself. Let me just see whether I can do that. Thank you. Okay, sorry. Let me give me 1 second, please. Okay. Share screen. I think it's this one here. Yes. Okay, so I hope you can see and hear me. So again, as I mentioned, the original discussant is not available. So I will give very short comments, not more than 5 minutes. Let me first say that I really like this paper because it's a wonderful combination of economics, of law, of regulation, and of technical details. So this is one of the cases where I actually learned a lot. And it is written, of course, in a way that actually definitely economists can also understand both the legal side and the technical side. So a great overview, cryptocurrency, the blockchain technology, and how they interact with each other. And then actually the paper, what most of the paper does is it discusses different legal and regulatory dimensions. So the anti-money laundering, the know your customer dimension, security laws, and then, but also taxation, which I think Andrei didn't have much time to talk about. And actually one interesting point that came out is the differences across jurisdiction. which partly seems to relate to difference in legal origin. That's an area where I've done some research 20 years ago, the differences between common law and civil law, which has very important implications, both for the role of different players, like regulators, courts, and so on, but also to which extent the legal framework has to closely adapt or is more open principle based, and things can be interpreted more by regulators and by courts themselves. So I want to have only 2 more slides here. I want to kind of pick up on 2 points that Andre made. And actually, this is his second point, the second challenge, as he called it, which applies, I think, applies not only to cryptocurrencies, but also to other dimensions of what we discussed today: FinTech, big tech, P2P lending platforms, and so on. So one is that we live in a world of national regulators, but providers are often international, or assets, for example, as Andre pointed out, are international. The distributed ledger technology doesn't have a certain location, or does have a location, but it might not be the same as where the regulator sits. And again, there are other examples. I mean, yes, Facebook is an American company, but when I don't use Facebook, but when my wife uses Facebook here in London, it's probably under the Irish subsidiary. Cloud computing, again, the same, which of course has been now partly addressed by the GDPR, but of course will, for example, be an issue after the end of the transition period here for the UK. So that kind of this trend towards globalization of providers of products, of services, while we live in a world of national regulators, that is definitely one challenge. And related to that, as Andre pointed out, there are these products, these service providers, which are not really inside the regulatory perimeter. And of course, there are lots of other examples. We had the money market funds in the investment banks in the run-up to the global financial crisis. We have maybe P2P lending platforms now, which, since they are not deposit-taking, but investment-based, are not subject to deposit insurance or the same regulation as bank, but maybe at some point they become too big to fail. Which is so in general, in systemic crisis, what we often observe, the financial safety net has to be extended to them for stability reasons, for political reasons, which of course then kind of gives the incentive to extend the regulatory perimeter as much as possible. However, we also know that whenever the perimeter is being extended, it's a bit like the balloon. When you press on one side, the air goes out on the other side, or the foam goes out on the other side. So then activities try to escape the perimeter by moving outside it. So it's a permanent kind of cat and mouse, cat and mouse game, where the regulators is always behind the financial institution and financial market participants, and which therefore what in some work that I did with Elena and Itai Goldstein, we call it the need for a dynamic regulatory approach, which of course is easier said and written down than actually undertaken in reality. So just one more point, which actually Andre brought out a little bit in his presentation. It's not as much in the paper. The impact on banks. So this kind of brings me full circle to the first presentation. So if we have central bank issued cryptocurrencies or digital currencies, sorry, I should say, would that undermine the fractional reserve banking system? What would be the role of banks in a world with diminished money creation power because of the central bank issued digital currencies? What would be the stability implications? I'm not going to give answers. I'm just going to put this as questions, just to also link maybe this paper and the previous papers, and to also show that it's beyond the pure consumer protection, the legal, the ethical, the criminal implication. There are important monetary policy transmission implications, but also financial stability implications. Again, I really enjoyed it. Thank you very much. And if I understand correctly, then I think Steve wants to also give a few comments, please.
Yeah, thank you, and Andre, thank you very much for an excellent presentation and for an excellent paper. And as I think I want to second Torsten's point, your paper is far richer than your presentation was, and so I would encourage people to look at it. The part of your paper that I think is, at least for me, was very important is there are two parts. One of them is that you describe, I think, in very nice detail, an entire ecosystem of tokens, if you will, of tokenization of various things. And I think that you didn't mention utility tokens or security tokens or ICOs or initial coin offerings in your presentation. You talked a little bit about asset, about these things as assets. But I think that those are very important because I think they're potentially very important applications, and applications that that don't raise a lot of the issues that are raised by what people like to call cryptocurrencies per se, by the Bitcoin equivalents, the thousands of those things where people, in my view, are basically trying to print money. And the other thing that I want to point out is that that I think is excellent is the need, and we have to think more about this, for regulators in general to take a different perspective than they have taken before. We need to avoid an arms race between the regulators and the private sector. And the question is whether we can make a shift, whether it's even possible for the regulators to make a shift to becoming more forward-looking rather than more backward-looking. I think this is an implication of what you're talking about, and I think it would be great. On the issue of the one technology that you described quite a lot in your presentation and is discussed in your paper on distributed ledger technologies, I think it's a big question as to where this is going. I think of these things as having they're sort of four different categories. They're either permissioned or permissionless. They're centralized or decentralized. The world has before the Bitcoin world was, before distributed ledger technology has been entirely one of centralized permissioned systems. The question is what we're gonna see, whether or not permissionless systems can really exist, or whether they're too costly, or whether or not they have compliance problems that are insurmountable. I don't know. Whether decentralized systems can really exist, or whether or not whether or not they become costly and slow. So what are the cost and benefit trade-offs between these things? For some things, I think you pointed out near the end of your presentation that for some things, effectively distributed ledgers work fine because they don't have to be fast. I think that speed becomes an issue in payments. So the question for me has always been, how do you get to the point where you can actually do what Visa does, which is have 25,000 payments clearing per second, or where the asset payment and settlement systems in the US, DTCC, the Depository Trust and Clearing Corporation, they want to make sure they can clear 75,000 transactions per second. And the question is whether or not, given the speed of light and stuff like that, whether distributed makes any sense. It doesn't actually have to, but because you can still have permission systems with various protocols. And then also, I think you did mention this, and I think it is important, you have to make sure that whatever systems you put in place, and this may, as Torsten suggested, imply a lot of international cooperation, you have to make sure that you're not facilitating criminal behavior. And that includes tax evasion. As well, it's not just about money laundering per se, or terrorist finance, or drugs or whatever. It's also about tax evasion, which is a pretty big, unfortunately, a pretty big business. So I think that I just want to applaud the comprehensive nature of your paper in covering a very wide range of a very wide territory, a whole ecosystem, as I said, of digital assets and digital money, and also discussing issues that regulators face. And I recommend it to everyone. So thank you very much.
Thank you very much, Steve. Maybe before I turn back to Andre, let me see, was there any questions, maybe from the KIF or from anybody else on the call? No, maybe not yet. So Andre, do you want to react to anything that Steve or I have commented?
Yeah, thank you very much, both Thorsten and Steve, for your discussion and for pointing out that this is a presentation for a general audience. There's an underlying paper that is associated with that, which is dealing with the issue of assets and with the issues of regulation in more detail. I teach an entire course on blockchain and FinTech here at Cambridge, and I devote actually quite a bit of effort in that to something that once you understand it a bit more, it just sort of starts really making you think differently. If any of you just sort of developed some proficiency in coding, it's at one point or another, you will recognize when you code, when you interact with the computer, is the computer is very, very precise, and you need to explain to it what you want in a very different way. You need to allocate memory and CPU capacity. You need to explain where things are, and then you need to direct it to do things. And so interaction in these digital domains, just sort of make you question some of the, and expand your horizons. And one of the things that really expanded my horizons is this issue of consensus. And once you start reading papers by computer scientists about consensus is a mechanism of agreement when you go from a previous state to a new state. There has to be a consensus. And so what's underlying centralized, decentralized, distributed, and all of that is a matter of consensus. How is consensus achieved? Who is in charge of actually deciding of moving from state to state prime? And so in a lot of the environments, it's a regulator decides, or financial institution decides, or combination of the two. And in a decentralized distributed system, you look more and more into how the proposal is made to go to a new state, and how the actual transition achieved. And the more you sort of read about it, you realize that the way they designed this blockchain technology is to think in the following way. Think that everyone, all agents participating in the consensus process could be compromised. No one could actually be trusted. And that is a very sort of, in my opinion, healthy way of thinking about it, because I've been involved with financial crises around the world for a very long time. And with me, it sort of resonated, the idea that no one can be trusted, because I've seen so many people and so many institutions misrepresenting themselves, getting involved in activities, and then doing all sorts of things. So, and the regulators as well on the regulatory side. So no one can be trusted. And then there is an internal threat and an external threat. So external threat is something where your systems could be compromised by external actors. Internal threat is something internally is incorrect in some way. It could be a bug, it could be deliberate, it could be manipulation. So again, thinking of regulation in the digital sense in form of external threats and internal threats, very, very healthy in my opinion, and really opened up my mind of thinking about it. And so the blockchain technology, in a way, just sort of brings to the forefront this fundamental concept that really no one can be trusted, and therefore the system has to be designed to be resilient. And yes, it will be costly, but then the cost has to be compromised against how resilient do you want it to be. If you want it to be as resilient as you can possibly make it, then you can build a fort, but you should also recognize that it's probably going to stop being resilient if you make it very resilient. So because of the internal threat. So that is, I think, one of the things that, again, I'd like to point out to the readers and those who are listening, that one way we can think of this technology is a way of moving to sort of digital regulation 2.0, moving in the direction of how do we evaluate actions, how do we evaluate states, thinking more about these environments we're in, less sort of from the institution-centric or even function-centric perspective, which has sort of evolved over time, over centuries, and more thinking from the point of view of internal threats, external threats, surfaces, transition systems, and so forth. I think I found it to be really quite rewarding to think of it that way. And especially when you come from a sort of regulatory background and you start thinking that way, I mean, I found it rewarding.
Thank you. Thank you very much, Andrei. Any other questions, comments?
I have one follow-on to one of the things that you just said, Andrei. I'm wondering about, I mean, one of the fundamental issues of compliance is identity. So I'm wondering how I deal with your comments about trust when I do need to ensure identity.
You do and you don't. So you can actually start thinking of identity. So the way that sort of one way that identity is approached, that identity is sort of 100% probabilistic, that you are either identified as something or you're not. Well, in reality, you know, especially in digital domains, if you want to ensure that identity is 100% probabilistic, then it will be expensive. And it will be expensive and the cost will be passed on to others. So one way of thinking about it is that something is identified to the extent that the probability of whoever is saying, or whatever this instrument represents, or whatever the state is over 50%, over 75%, over 90% correct. So your identity becomes probabilistic. Identity in the sense of the state, identity in the sense of security, identity in the sense of an order type. Because as you mentioned, and I've done some research on it, it's actually not that far-fetched, because one of the things that's related to high-frequency trading, especially at very, very low latencies, is that time becomes probabilistic. It is no longer strictly defined as time 0 and time 1. It's actually drawn from a distribution for technological reasons. Similarly here, identity for technological reasons becomes probabilistic. So if you insist upon identity being in a digital domain, you can insist upon identity in the physical domain to be 100%. Because it could be verified. But in the digital domain, identity, quite a bit of work has been done on it. And especially if you move into a quantum computing territory, identity actually becomes very probabilistic very quickly. So that's one way of thinking about it. I don't know if it's too far-fetched, but that's an answer where I'm at.
Thank you. That's fascinating. Leonardo, you had a question or comment?
Yes. I have a question for Andrei. I'm very interested in his opinion as an academic on central bank digital currency. In particular, we see also from our studies that there are different options. You can have wholesale central bank digital currencies. You can have retail for everybody. You can have token-based. You can have account-based. So there are different options. And from your perspective, if you could, I don't know, just envision bet on what will be the central bank digital currency in the future, if any. What is your view?
Okay, Andrei, if I may ask you, give a very quick response because we have to move on. Sorry.
Okay, yeah, so very quickly, I think the paper that that you guys have put out is very good. I also think that my view are sort of at this point fairly close in that domain to the Bank of England, not because I'm in England here, but fairly close in terms of the architecture. And the architecture that I think that makes a lot of sense is that you have the backbone, which is provided by central banks, and on top of it you have the application layer. And the application layer is private, so you can write application layers on top of the backbone, and the backbone of central bank digital currencies. This really are messages inside the operating system, and the operating system is sort of supported and protected by the public, by the central bank, and on top of it you can write apps, and these apps should be private. And then I sort of support this as an overall architecture. By the way, the amount of work that's done on enterprise type of blockchain, state supported blockchain, and the big tech supported blockchain is absolutely amazing. There are a lot of people working on it. So on cryptocurrencies, there seems like, there's not much going on. On the blockchain, actually, there's a lot going on. Lots of people actually working on it. And there is a lot of talent, and that talent could really be put to good use with these applications. Did that answer your question?
Yes, thank you very much.
Well, thank you very much, Andrei. Thank you, also everybody for their comments. If I may suggest to take a 2 or 3 minutes break and then come back. Antonio, if you want, you can start sharing your screen and then we can start in around 3 minutes, please. Okay, thank you. Antonio, now you can share your screen. Sorry, yes, wonderful. So Antonio Fatas from INSEAD Singapore, followed by a discussion by Leonardo Gambacotta from the BIS. Over to you, Antonio, please.
Okay, thank you. And thank you for the invitation to present in this conference. So this paper is trying to look a little bit forward, not just backwards, to think about sort of like what type of developments will FinTech and any other changes in this market will bring going forward. And the way to answer that question is obviously we don't have a crystal ball, but the idea is to look in particular at the comparison of what has worked so far in different countries and why is it that different countries have reached a very different equilibrium so far. And I'm going to emphasize what is in the title is the role of market structure, initial conditions, and also the role of regulation in different countries. And that's how we got to where we are today. And it's very likely that we'll see a lot of persistence going forward. Now, I don't need to talk too much about all the activities in FinTech that are part of our discussion today because of the first paper, but let me just make obviously a broader statement saying we've seen a lot of developments and interesting developments in some segments of financial markets. At the same time, in some cases, FinTech remains small relative to incumbents. But again, the big question is how far can these developments go? How much can we challenge the incumbents' role that we see today? And I'm going to explore in particular difference across countries to understand that. And I'm going to focus on these 3 or 4 bullet points: market structure, regulation, public infrastructure, and the interaction with activities which are outside of the financial market. Now, I'm just going to give some examples, some big numbers to sort of highlight difference across countries. If you look at payments, if you go around the world, you see very large differences. If you go to China, you have 2 big players that come from the big tech world that dominate mobile payments, WeChat Pay and Alipay. If you go to Africa, for example, in Kenya, you see telecom companies growing very fast on the mobile payments sector. And in fact, mobile payments in Kenya today amount to 85% of GDP, which is a very large amount by the standards of even advanced economies. If you go to Europe, you see the dominance of contactless payments that today account for about 50% of the point of sales that you see in stores. But then the same type of evolutions that we would expect to see in other countries, we don't see them. For example, if you do the parallel with WeChat in the US, the equivalent of WeChat, what is like a big platform in the US, messaging platform and social media platform, it will be Facebook. Now, Facebook has been trying to enter the payments territory all the way back to 2015 with something first payments through Facebook Messenger, then with something that they call Facebook Pay. This is way before Libra was even an idea, but it hasn't gone very far. If you look at the dominance or the size of Facebook Pay, is tiny or insignificant compared to anything else we've seen in China with some of these platforms. So we can start seeing these differences between countries, and the question is, where do those differences come from? Now, this is not just about payments. If you look at asset management, for example, you have situations like in China where you have Yuebao, which is an incredible large money market fund. Today it's about $150 billion. It was about 250 a few months before. You see in the US, the world of robo-advisors and sort of electronic trading companies, E-Trade, Robinhood, a recent one, or Betterment, which are decent in size. Of course, nothing compared to the traditional ones like Schwab. But then if you try to look for a parallel in Europe, you don't find anything that resembles this. You don't see anything that looks like a FinTech company that is in the business of asset management that has increased their volume to be sort of a true competitor to the traditional competitors. So we see it in payments, we see it in asset management, we see it in lending. I'm not going to go through this data here. This comes from a paper of the discussion of my paper, Leonardo, that looks at different alternatives, the different investments of FinTech and Big Tech on lending, compares across countries, and you also see large differences across countries. Now, the paper goes through a lot of these examples in different segments. What I plan to do for my presentation is just focus on one of them. So I'm going to focus just on digital payments. I'm going to ignore asset management. I'm going to ignore lending. Now, why focusing on digital payments? Partly because it's one of the segments where you see more activity. It's also a segment which is central to financial markets. At the end, any financial markets transaction has to have some payment attached to it. And in practice, we've seen a lot of action in the payment sector or in the payment service sector as an entry point to other services. So it seems to be quite central to the discussion we're having today about the role of financial innovation in financial markets. Now, let me just make two broad statements, which is we all think about like the payments revolution as a consumer. We all talk about it. We talk about the need for payments which are instant, which are mobile, which you can do at any point in time, and which are costless. We think about either zero cost or close to zero cost. Now, of course, the reality behind this, what I'm going to call the back office, is very much more complicated. And you will see that's the point that I'm going to highlight through the next slides, which is, of course, it's a lot more complex than that. And if you just throw in my slide a set of logos of companies or initiatives that most of you probably have heard, or at least some of you have heard many of them. Again, there's a lot here, whether it's Apple Pay, whether it's Samsung Pay, whether it's Bitcoin, whether it's Zelle in the US, Swish in Sweden, GrabPay in Malaysia. They all sort of look similar to a consumer. These are forms in which you do today payments which are fast, costless, mobile, but the technology behind and the place in which they enter into the financial markets is going to be very different. So I'm going to highlight the difference between these experiments, and each of them obviously belongs mostly to one country or several, but to one region. And I'm going to highlight why those things look so different, even if from a consumer point of view, some of these things might look very similar. But of course, it's going to make a big difference when you think about the market structure and the competition. Now, every time we talk about payments, we all go back to our definition of money. Andre, in his presentation, was talking about Agustin Carsten's referring to cryptocurrencies as this is not money, this is something different. And obviously, he's going to our standard definition of money, which is in every textbook of economics, certainly macroeconomics or monetary economics, that says money has to be a unit of account, has to be a stable value, and has to be a medium of exchange. This is a definition that fits perfectly with physical money, which is the best example we can all think of money, currency. It carries the unit of account. If I hold a banknote in US dollars, that's where the number is that says how many dollars that banknote is, and prices will be referred to that. It's as stable as the unit of account, and is the medium of exchange because it has the legal tender property, so it has to be accepted as a medium of exchange. Now, an argument that I've been making now for a while is that this definition becomes almost meaningless when we talk about digital money. And it becomes meaningless because to a large extent, the unit of account that is incorporated in digital money tends to be referred to as the same unit of account in digital money, in physical money. So that property is inherited from physical money. For example, if you think about the most common form of digital money that we all use, which is sitting in bank accounts, sort of the unit of account, the stability of the bank deposit is very much associated to the fact that one can convert bank deposit money into physical money. That's sort of the anchor that we establish. And of course, that has to do with the balance sheet of the bank, but it also has to do with the regulation, including deposit insurance, under which bank deposits are run. And this is a historical development where we are because of the history of banks. We can obviously think of different forms of digital money that will look very different. And obviously that's some of the things that I will discuss over my next slide. But now let me make the last point, which is going to be the most crucial one. When it comes to digital money, it is very difficult to think about how does digital money become a medium of exchange unless you define the payment technology you're going to use. So I can have money in my bank account, but if when I go to a store, the type of debit card, bank card, credit card that I have are not accepted, that money is not money anymore because it cannot become a medium of exchange. Now, I'm going to emphasize that very much what we've seen across countries in payments innovation has to do with that last bullet point, not so much with the sort of like fundamental definition of money, but changes to the way we exchange money through payments technologies. Now, I'm just going to do a quick drawing of what payments technology look like today, obviously a very simplified one, to try to illustrate the contrast between the asset and the payment technology. So today we have merchants, customers, and we're trying to do payments from one to the other. Now, what do we need? We need to have assets. The assets are in blue here. I have bank accounts for the merchant, for the customer. And I also have assets which are sitting at the central bank, which are going to facilitate the settlement. Now, these assets need to be connected by payments technologies. And these technologies happen at two levels: the settlement, which is typically controlled by the central bank, and then the payment network, which is the way the customer is able to transfer the money from his or her bank to the bank of the merchant. Now, that payment network, as I'm going to discuss in the next slides, is obviously very complex. It involves lots of pieces of hardware. It involves networks that connect all the different players in this picture. And here is where we're going to see a lot of action when it comes to innovation. Now, before I talk about that network, let me remind something about the assets. Now, when we open the balance sheet of the central bank, what do we see? We see the digital money. This is sort of the current version of central bank digital currency. Of course, we don't call it like this because it's only available for commercial banks. And that digital money is sort of together with the currency on the liability side of the central bank. And the anchoring of the value of the digital money is sort of very much associated with the physical currency. Of course, one day it might be that physical currency does not exist. That's not the case today, where that physical currency is still there. And when it comes to the other form of money, the other asset, which is the bank deposits, it's sort of the same story. Your bank deposits are linked to two things. If you want the currency that you can withdraw in an ATM or you can take from a bank teller, so that guarantees the redemption of your bank deposits into currency. But you can also think about the reserves of commercial banks at the central bank, which are able to facilitate transactions. So when you do a payment at a merchant, at the end, you need those reserves at the central bank to be able to make the balance on your bank account to be actual money. So on the asset side, what I see is sort of three assets, the physical one and two digital ones, but they're very much interlinked in their value. The one-to-one value that you associate and we all associate between these assets has to do with the fact that these are linked through balance sheets, but they're also linked through regulation, in particular deposit insurance. Now, let me start sort of disrupting that system. I won't say much about cryptocurrencies. Andre has talked about it and his paper is very thorough, but let me just say from the perspective of my infrastructure of payments, cryptocurrencies do something which is obvious, which is they collapse all those layers into one. So cryptocurrency, the idea is we all sort of bank with the same bank. We all have balances in the same system. So in some sense, I know this might sound odd, but it becomes a centralized system because we reduce all intermediaries. By doing that, we facilitate transactions. Of course, the technology might not be as fast as we would like, but from a design point of view, it seems to work. Of course, there's lots of complications. The biggest complication is that we have to create a separate unit of account. And because of that, we have the additional volatility which might not be good enough for this to become money. And that's what sort of we saw earlier in the quote saying cryptocurrencies might not be money. But still, they might be successful for other reasons. And I want to highlight one because it's going to be useful for some of the other developments I'll mention. Cryptocurrencies have been very useful for people who needed a plug and pay payment system. So you want to start a business which is digital, that lives in the digital world, and there's lots of those businesses today. You need to have a payment system associated with that business. It is very easy to start a payment system in Ethereum because it's already built into the platform. So it's very easy to sort of use the same platform that creates these cryptocurrencies to create a parallel business and put the two together. And again, I want to highlight this because this is an example where it is not the asset that makes the difference, it's the platform that makes the difference for those who say, this might be a good idea for my business, for my implementation. Now, I'll move away from cryptocurrencies to what I'm going to call stable coins.
5 more minutes, please.
Yeah. So when it comes to stable coins, I want to say very few things, but the one thing that I want to say is how there's a parallel between stable coins and things that all of us are using every day. So stable coins is very much about anchoring the currencies that I've called before cryptocurrencies to the unit of account, which is the traditional unit of account. Now, from an economic point of view, forget about technology for a second. This sounds very easy. I'm going to refer to what we normally call narrow banks. I'm doing a quick balance sheet here for a narrow bank that says, well, I could issue a liability, which I'll call a stable coin, which is going to be backed by a form of money that we all recognize. I'm going to make it very simple and say reserves at the central bank. So if I'm allowed to have reserves at the central bank, I could create a stable coins where the value of the stable coin is clearly 1-to-1 because it's backed by the reserves at the central bank. Of course, we have to deal with regulatory aspects. We have to deal with the technology side of it. But from an economic point of view, this sounds like a creation of an alternative form of money. I'm going to call it a stable coin. And all the properties are inherited from a traditional form of money, in this case, reserves. Now, of course, when you look at that, that looks very familiar because we've been doing this for a while. We've been doing things that look like stable coins for a while, again, from an economic point of view. If you have a card with a retailer like a Starbucks, if you have an account at Venmo in the US, if you have an account at PayPal, a global company, if you have a wallet with WeChat, or you have money in the balance of M-Pesa, or if you want to go to more recent evolutions of a stable coin, DAI, and then Libra, which doesn't exist yet. DAI is a cryptocurrency version of a stable coin. In all these cases, we have a picture that looks like that balance sheet. We have a picture where we're creating an asset that inherits all the properties from another asset, which is sitting on the other side of the balance sheet. So the innovation here is obviously not on the economics of this. The economics of this sounds obvious. The innovation here can be and should be on the payment technology. Somewhere in these labels, we should see a payment technology which is superior to the payment technologies we see earlier. Now, here's where my cross-country experience is going to come in. So how do all these experiences, all these possible innovations show up when you look at the world? And I'm going to emphasize it all depends on the initial conditions where these markets started. And when I say initial conditions are very much driven by what did the market look like, the market structure look like when these innovations were coming up? And then how did the regulators reacted to these changes? Now, let me do a reminder. We're talking about innovations in payments. Innovation in payments typically are going to be centered around a technology, which has to do with a device that is sitting in our pockets or in our table right now, which is a phone. Of course, it could be a computer. It doesn't need to be a phone. But a lot of the examples I'll give have to do with mobile payments for sure. Now, let me do examples which are simple. Let me start with countries where the bank presence was minimal. So the idea of digital payments did not exist. If people don't have bank accounts, you cannot have digital payments. But then you have a device that is sitting on everyone's hand, which happens to be a telephone. And telephone companies happen to have balances for every user of these telephones. Now, those balances can easily become money. And this is the way digital money was developed in these countries. It's sort of a natural consequence of a lack of banks and a technology that was available in everyone's hand. Now, if you come to Asia, in particular to China, you start with banks that I'm going to be calling them relatively weak. I'm going to say relatively to other regions that come next. You have a lot of e-commerce. So people are very used to the idea of digital payments. You might start with computers. You might follow with mobile payments in banks. You have a regulator which is open to innovation. And then you have these big platforms, I'm going to call them big tech, which have an easy way to enter peer-to-peer payments via the platforms that they use. If you have a messaging platform, it's going to be really easy to implement a network of payments, because once we are connected, sending money to each other is sort of already built into the platform that we have. So obviously we have the growth of WeChat Pay, Alipay that take over and dominate mobile payments. Now, in some other Asian economies, we complement this with what we call super apps. So all this mobile commerce reaches the mobile phone. So now you have an app that sort of does everything from you, from ordering food to order a taxi to do your dry cleaning. It sort of becomes very natural to be part of that platform as a payment system as well. So it's a natural evolution from the previous one. And you see this in Malaysia, GrabPay, or in Indonesia, GoPay, which are applications which are not just payment system, it's just part of the ecosystem. It feels very natural. Again, the economics behind it is very simple. The payment technology is very much associated with the development of these companies and how they got to where they got.
So Antonio, now, 2 more minutes.
Yeah, I'll do a couple more things sometime. So if you go to Europe, you see something which is very different. You see countries that mostly had very strong banks. You had a regulator and a central bank that were fairly proactive when it came to instant payments, fast payments, low fees for credit card and debit cards. So there you have a payment system that works through banks, which is quite efficient. So the idea of bringing competition to this bank payment system is very hard. So there's very limited room for fintech, and you don't have a lot of developments there. Now there's some sort of companies that start with peer-to-peer payments. Why? Because banks were not quite as flexible as consumers would like. So if I want to send you some money, if we have a dinner together, the banks were not there yet. So that's how they started. But the only way to move forward is for them to become banks. So you see this in Europe with a bank like N26. You see this in South Korea with Kakao that started as a peer-to-peer system and then moved into a bank afterwards. And then you have the case of the US, which is a little bit special because it combines the strong banks, a central bank that didn't move that fast, at least not as fast as the European ones. And then you have this credit card culture that makes the credit card the center of the payment system. It's really, really hard to compare with that, to compete with that technology. So you see what I'm going to say is limited innovation in payments. There's sort of some entry points. Once again, peer-to-peer payments can sort of take off, but they might not grow that much. E-commerce could be an entry point, but it's less obvious as well. And you have the experiences of Venmo or PayPal, which have been successful. Now, what are the other things we see? We see the fintech and big tech companies partnering with credit card companies or incumbents with banks. So we see Sele, which is becoming very popular in the US, which is about linking bank accounts, but it's sort of partnering with banks. Or you see companies like Apple, partnering with credit card companies, traditional ones, Apple Pay, Apple Card, to do that. Now, let me just say one more thing about all these experiences. So I'm emphasizing initial conditions, I'm emphasizing regulations. I want to emphasize one more thing, and there's a lot of details as well. And these details are going to be changing over time as technology changes. Okay, what do I mean by details? In all the examples I've given, there's, for example, the key role of standards to develop a sort of a large, widely available payment system. It can be standards when it comes to identity. How do we recognize who's the owner of an account, or who are you, who am I? How do we recognize a merchant? The development of standard QR codes, which is a large development that we've seen in some countries that have helped changing completely the payment infrastructure. There's issues of how you authenticate people. How do you know who's who? And you have companies like Samsung or Apple that dominate the smartphones, and they also dominate the biometric authentication. They are the ones who are the gatekeeper to decide who can use that Touch ID or Face ID that is sitting on the smartphone. You have developments of bank-to-bank transfers more and more. You bypass completely the credit card infrastructure. You sort of bring banks back into control. But you also have other things that like reduce the power of banks, like open banking. And again, this might change as well, the potential developments of different types of the system. And then you have finally the CBDC discussion. We've had already a conversation around that before, which could be a game changer, but I want to bring an intuition that I brought in the previous slides. For CBDC to be a game changer, from my perspective, the CBDC has to go all the way to cover the last mile of payment technology. Just creating the asset will not build a resilient public system of payments, because it will still need to rely on the payment technology that will have to be in the hands of the private sector. So once again, it's not so much about the asset, it's about the payment technology, and the payment technology is a lot more complex. That's some of the simple definitions we've been using about money before. So let me stop here. I'll stop sharing. I'll pass it to Leonardo. Thank you.
Thank you very much, Antonio. Great overview. And now over to Leonardo. Leonardo, are you there?
Can you see my presentation?
No, we cannot see anything right now. We can neither see you nor the presentation. It's kind of odd. Do you want me to send you the presentation? Do you want to send me the presentation so I can share it? Leonardo, are you still there? Might have lost Leonardo.
Still connected. I see his name and the participants there.
He's unmuted. He's muted and. Leonardo? Oh, he's now reconnecting somewhere else. I see. Leonardo, yes, we can see you. Now you just have to share your screen.
Sorry, I had the problem with my connection. I'll try to share the screen if possible. Just tell me if it's.
Yes.
Can you see my screen?
Yes, we can see it.
Yes.
Go ahead, please. Thank you.
Okay. So thank you very much. It's a great pleasure and honor to take part to this conference and discuss this paper by Antonio on market structure regulation and the FinTech revolution. The paper provides a very nice overview of the recent technology-related change in the financial and the banking industry. In particular, the paper analyzed differences in FinTech adoption across countries to understand what are the main drivers of development of digital money and payment. Indeed, the paper focused on digital money and payment, but has a nice discussion on other financial services, namely wealth management, insurance, lending, and fundraising. So the analysis is very rich and complete. I really suggest you to read the paper. The paper finds that the factors that better explain cross-country differences are the initial market power of incumbents, public policies related to regulation or the provision of public goods, such as an efficient payment structure, and the existence of digital networks that can easily migrate into financial services. So through the analysis, the paper looks at the response of incumbents, in particular of banks, to change in the in this new competitive landscape. And finally, the paper looks at regulation, but it does not fully develop this part. I think this is for good reason, because Antonio looks at the cross-country dimension, and the regulation for FinTech is not very developed so far. So in my discussion today, I would like to complement Antonio's analysis with a few points on regulation that could be useful to develop more this point, and also for the discussion, if we have time. I will take an angle that is also different from what Xavier already discussed previously. So we know that public policy should maximize welfare. So this can be reached maximizing the overall benefits of FinTech, minimizing its costs. So to do this, public policy typically sets some intermediate objectives. And to reach this objective actually is not simple when we are in a situation with digital innovation. This because FinTech may give rise to complex trade-off between three categories of policy goals that are synthesized here in this slide. So we have financial stability and market integrity. We have efficiency and competition, and data privacy and consumer protection. So these trade-offs can be represented as a triangle. So let me first start with the competition financial stability nexus that is represented by the red arrow in this slide. Regulators in the past have long debated the relationship between competition and financial stability. There are in particular two lines of thoughts that on the competition stability nexus, an initial school of thought emphasized that greater competition was not always optimal or conducive to financial stability, because more competition reduce banks' profit and their overall franchise value. A second, more recent school of thought argues that greater market entry in the financial sector is desirable, as it fosters competition and reduces incumbents' market power. However, FinTech and big tech entry into finance may change these paradigms, and in particular due to their data network activity feedback loop, the relationship between market entry and competition may change dramatically. So big tech, for example, control key digital platform in e-commerce, search, or social media, and have access to a lot of data, and this may create a situation of digital dominance. So this could also create some form of conflicts with respect to the product they sell. For example, when big tech sell on their platform products of their competitors, that could be also banks. So in India, for example, the main e-commerce platforms are prohibited from selling products supplied by affiliated companies on their website, including the financial products. So this to avoid the potential conflict of interest. So just as an example of how entry in the payment market by big tech could affect competition, this slide shows the M&A activity by digital platforms, big tech, and card networks, and it divides forms of vertical integration in red and horizontal form of integration in blue. So the slide shows the deals from 2014 to 2020. What I want you to notice is that there are a lot of increase in this acquisition, and this could reflect that big techs and other dominant players in the market buy the best fintech companies, and so the new companies could be acquired before getting a critical mass of users. So the overall effect of competition is really an open question. Let me pass to the new dimension that we need to explore, this new competition privacy nexus. This is represented by the blue segment in the slide. So while competition and more efficient solution may often benefit consumers, there are also tension, particularly around the data privacy. So in the absence of privacy concern, of course, web access to data would be in principle be very efficient. One aspect of the use of big data as an input into the production is that the data can be used many times and by any number of firms simultaneously without being depleted. So this is called non-reverse. At the same time, free sharing of data can be harmful for individuals. For example, open access to personal data can allow for identity theft, reputational damage, and the manipulation of behavioral bias to sell some consumer products that, for example, they are not in our own interest. This is just to name a few examples. And another particular risk is the monopolistic use of data. So big tech companies are very efficient in pricing. They can parse the population of potential customers into finer and finer subcategories, each matched with the different price. But they can therefore extract all the consumer surplus. And another challenge is that these algorithms used to process the data may also develop bias, leading to unethical discrimination. In particular, the outcome of artificial intelligence processes may disadvantage certain groups of consumers, while less human intervention means that test-based discrimination may decline. Algorithms developed by humans or trained on historical data can introduce a new form of bias. Just so this needs that we need to position on this efficiency privacy trade-off, and this is a societal choice and depends on preferences. Just let me show as an example a recent studies that we are conducting here at the BIS using a EY survey. We find that men are more likely to use fintech products service than women. It's 27% against 19%. And this pattern holds in almost every country and also by subcategories. And it is very strong in payments. So let me just turn to the third type of trade-off to investigate. That is the one between privacy and stability. So this trade-off, it is between consumer protection more in general on one hand and financial stability, that is market integrity on the other hand, is represented by this green segment in this slide. So in general, theory shows that data sharing, alleviating problems of asymmetric information is very beneficial for financial stability. For example, there is a lot of evidence of how this takes place in the credit market by using, for example, credit registry. But at the same time, as the experience with the credit registry shows, there is also a downside that is the limit of privacy. So in a world of digital innovation, in which a much wider range of data is available for screening, there may be an even higher premium of giving individuals the access to our own data and the rights. And one important area that is also very well analyzed by Antonio in his paper is on payments, is on reducing illicit activity and preserving market integrity. And this can have a cost in terms of privacy and serving customers. For example, anti-money laundering and combating the financial of terrorism practice require the exchange of detailed information on all parts involved in a transaction. And this could reveal habits and preference, of course. So let me just conclude very briefly. From Antonio's paper and my slide, we have seen that there are some new trade-offs between public policy objective that call for more coordination between national authorities. I'm talking here about competition, financial regulators, and data protection supervisors. Moreover, as the digital economy expands cross-border, there is a need for international coordination of rule and standard. So Antonio's paper, I think, is a very, very nice contribution to analyze differences in fintech adoption, common technological trend, and the adoption of public goods. And I think that analyzing these trends and these technological difference could really reduce the possibility to have potential conflicts in the future. So let me stop here, and thank you very much for your attention.
Thank you very much, Leonardo. Before I turn back to Antonio, are there questions, comments from the floor, from Saul maybe, other participants?
I have a question for Antonio, more like a comment, if I may.
Yes, please.
Yeah, thank you very much. Wonderful presentation and the discussion. And what I wanted to mention is there is something that I came across, once I came from the to add to what you said about market structure and sort of national regulatory system. Something that I came across in the UK that is different from the US is that in the UK there is this explicitly set up what's called a competition mandate. So regulatory agencies actually have a competition mandate. In the US, as far as I know, market regulators and prudential regulators do not have an explicit competition mandate. They have there are agencies that have anti-competition mandates, such as the antitrust type of mandate. So if you've become a monopoly or very large oligopoly, then there is a mandate to dismantle you. But there is no mandate, explicit mandate to actually promote competition. And this competition mandate actually most recently has been used to promote mobile-only banks, neobanks, to promote P2P platforms, because otherwise, if you're a regulator and you're in the regulatory environment and you say, well, you have to be more flexible, and you say, what's my mandate? I mean, you're a public agency, you can't just go and be flexible, And so, and especially if you have the new mandate, which is financial stability, the most financially stable system consists of one entity, which is a central bank. So that's as stable as you get, right? So if you don't have a competing mandate, which is along these lines, which I've seen actually been used here in the UK, is then as regulators, you could end up, technology naturally translates, especially digital technology, translates into a winner-takes-all kind of structure, where you have one entity which is slightly better than others that becomes the dominant search engine, or the dominant clearinghouse, or the dominant provider of other types of digital technologies. So what's your view on kind of this competition mandate, and how do you see that just sort of shaping things up? Thank you.
Thanks. Maybe shall we first collect questions? Maybe.
I just want to. I did have a question, but first I wanted to say that I wouldn't use the U.S. as a guide for any of this. There are different competition mandates in different. There are well over 100 financial regulatory authorities in the United States, and some of them do actually, Andre, I'm sorry to say, for better or worse, have competition mandates. And it's certainly the case that banking licenses are issued based on competition considerations, although you may claim that, and I would agree probably, that they're the wrong ones. But my question is about the role of central bank retail payment systems and how that affects your views, Antonio. So many countries, jurisdictions do have small value retail payment systems that basically connect individuals' bank accounts across the country, and the U.S. is in the process of creating one of those. How should I think about those in the context of your analysis?
May I ask another question?
Yes. Okay.
Is the issues? It's question comment. I think that in the realm of digital currencies, it's very important again, how are they backed? And in fact, at the end of the day, who has access to the central bank reserves? This will be, just a second, sorry. It's a problem being at home. Sorry. Okay. How it will be, how it will develop a system of digital currencies or different digital currencies will depend very much on how they are backed up. And so whether they have access, for example, to the lender of last resort or not. And this is, this may be a dividing line, and I don't know if you have another, any comment on that.
Okay, let me see. Before I give the floor to Antonio, just a moment. Yes, I think you have a comment, please. Yes.
I have three relatively minor questions. One is, Antonio is saying the P2P provided entry point for Kakao Bank in Korea. That I don't understand. And the second one, the telephone company can become a bank. There is, they have the money, they have the network, and they have the technology. But then this bank would be any different from internet bank. They are created in many countries, including Korea, for instance. And what would be the significance of allowing or giving banking license to telephone companies? And in fact, the P2P and crowdfunding, they have access to the payment technologies. And if they can obtain a banking license, they can create the commercial bank anytime they wish. So the point, the important point is, again, we have to, what would be the structure regulation governing banking activities? In other words, that we have a banking law every country, and does this banking law, as we know, can deal with the emergence of so many banks created by technology companies and other fintech companies?
Thank you very much. Antonio, over to you. Lots of questions.
Yeah, I'll give a short answer to most of the questions. I mean, I think let me start with Andrei's question. I think you bring in a great point. So like different regulators have had different approach to competition, whether it's on their mandate or not, but clearly the measures have been very different. Again, I think it depends a lot on the context. I think what does competition mean in the context of the UK is trying to open the door for startups and fintech to compete with established banks that are very strong. Now, what does competition mean in China? I mean, here we're talking about a very different story. The question is, how do you protect the financial system from having big tech companies that dominate the financial system? And this opens a question which I think is a lot more complex than the usual question we've asked when it comes to financial regulation. And here is where the presentation that Leonardo did is very much appreciated, because I think the BIS is thinking very hard about this, thinking about the connections between financial regulation and other areas which are fundamental in this particular question, which are not traditionally part of financial regulation. And a lot of them has to be with platforms, it has to do with data, it has to do with conflicts of interest. And these questions become really complex. And I like his triangle because it's a nice way to start thinking about some of these issues, but they become very difficult. And if you add the international dimension, it's very, very hard to come up with one easy answer. Now, a couple of other questions about CBDC. Again, the retail payment system. Again, to me, that's a simpler case than, the wholesale payment system is a simpler case than the retail payment system. When it comes to retail payments, again, my point of view is that you need to go all the way to the last mile of the payment. Otherwise, creating the asset, I don't think fundamentally changes the level of competition that we see in payments. When it comes to wholesale payments, of course, it's a very different story because you don't have to go all the way to the consumer. So it might be easier to implement, and maybe that's why we talk faster about wholesale payments than retail payments. The point that Xavier made about access to central bank is crucial, yes. And that's the point that I tried to make in my paper. The way these pipes work are fundamental, and giving access to central bank can create a different level of competition than not giving access to central bank. But the moment we start saying things like this, we get into a complicated set of other questions, because accessing the central bank is not just accessing the payment system. It's also typically accessing to the lender of last resort. And we need to probably unbundle some of the traditional ways we thought about payments and access to central bank or banks themselves to be able to come up with the right answer. Otherwise, too many things come together when you open one of these pipes. And then the final set of questions, I was referring to Kakao Bank as a bank that is started from the electronic wallet perspective. So that's what I call a P2P perspective, and then became a full digital bank. And then the broader question is, what does it mean when we allow for companies to open a banking license, to apply for digital banking license? How does it change sort of the level of competition? Again, obviously you can have new startups, new entrants becoming banks. We've seen that in Korea, we see that in Europe, we can see it in many places. But the question is whether competition can come from segments of what banks do, which are the most profitable one, and maybe going forward become the most crucial ones. And again, here payments is a fundamental part of what banks do, in particular when it comes to data. And if you can have all the data associated with payments, you can have a lot of the data that big tech companies are about. Now, as the pipes of the system becomes more fluid, as it becomes easier and easier to connect all these repositories of money, you might imagine worlds where your bank account is just a repository of money, but all the action you do with your phone or with your watch or with your computer is controlled by someone else. And that someone else could be WeChat, it could be Facebook, it could be someone else. So you don't have these companies becoming banks, but they could take either the data or some of the business segments that are the most profitable ones to banks. Okay, I'll stop here.
Thank you very much, Antonio. Maybe just if I can add myself, so I've done some work mostly on developing countries on the regulatory framework for these fintech companies. And I mean, for example, Safaricom in Kenya, who runs the M-Pesa payment system, does not have a banking license because it's purely payment. However, it does it cooperates with banks when it comes to specific products that use the M-Pesa network. So I think there is yes, it's regulation is not one size fits all. I mean, you have the prudential regulation, which is really for the intermediation function, deposit taking, and therefore the financial safety net. But you also have kind of less, I guess, riches or less prudentially oriented frameworks for firms that do not intermediate or that are not directly under the financial safety net. Of course, the borders between these different segments is very much fluid. So it's a constant regulatory challenge, I would say.
Correct.
Thank you. So if there are any further questions, comments? If not, I'm aware we're running a bit over time. I'd like to thank everybody. I'd especially like to thank our hosts in Korea, for whom it is actually already, I think, almost 11 p.m. For their patience with us and for giving us, of course, the opportunity to present and to discuss. I'd like to thank all the presenters, all the discussants for their participation, for their interventions. And I'm very much looking forward to the second day tomorrow. Same time. In this case, Steve will be the chair of tomorrow's sessions. If there's no further remarks, let me maybe close here and look forward to seeing everybody tomorrow.
Thank you very much.
Thank you.
Thank you.
Bye.
Thank you.
Thank you.
Thank you very much.